Hello guys, welcome to the next Trading Up YouTube mentorship program. So this is going to be the 8th episode in the YouTube mentorship program, and we're going to be looking at the market's conditions. You must have an understanding of market's conditions because it is very imperative. Understanding market condition is imperative to carrying out a high probable technical analysis. When you're analyzing an asset class and you can't really define the condition or direction of the markets, how can you determine your bias or think of becoming a profitable trader? So you must understand that market condition is the most important key to your analysis when looking at the charts. So we're going to be looking at the various market condition, which is also what we can call market structure. So first that we're going to observe is that we have the bullish market condition. So the bullish market condition is actually meaning a buying market condition, an uptrend market condition, where we are actually having price moving higher. That is what we call the bullish market condition. So the bullish market condition is a market condition that has series of higher highs and higher lows. So because now you can see this is actually the basic structure for a bullish market condition. We have the push to the upside and then we have the pullback. What you can see is that price created a high here and then price created a low. And then we also have the movement of price to the upside. Now price created a new high point. But this now is actually a higher high because it is higher than the previous high points. Price gave the movement to the downside and created a new low. But then this low point is actually a higher low because it is higher than the previous low points. And then we still have a movement of price again to the upside. Price created a new higher high because this higher high is higher than this other previous higher high. And then we have the pullback to the downside creating a new higher low, because this low point is higher than the previous low points. So this is a bullish market condition. So when you have the movement of price in the direction of the trend, that is what we call the impulsive move or what we call the expansion. And then when you have movements against the direction of the market, against the established directional bias, that is what we call the pullback or what we call the retracements. So meaning this is the impulsive move or what we call the expansion. And then this is the corrective move or what we call retracement or what we call pullback. So you can now see the impulsive move is in the direction of the trend, which is actually a bullish market condition. So the corrective move or what we call the retracement or pullback is against the direction of the markets. So you can see this is a buy movement. But then the pullback, or what we call the corrective move or retracement, is now a sell movement because you can see prices falling to the downside. So it is actually against the trend. Price is actually pulling back to actually fill up some form of inefficiency, take out liquidities resting within the expansive leg move. And then you would see that now price will mitigate a zone in that higher time frame. So when we continue, you get to understand the inefficiency zone, the liquidity zones, and all other parameters that you must understand in understanding market conditions. So now you can see price created this low, and then we have the expansive leg move. So the bullish market condition is actually a market condition creating series of higher highs and higher lows. So next we have is actually to understand the swing points in a bullish market condition. So when you have the expansive leg move to the upside and then price pulls back to the downside and creates a low and then gives an expansive move. So you have a swing high here and then you have a swing low here. The same thing happens here. Price creates a swing high and a swing low. So the swing points are actually turning points in the markets. So the swing high actually leads to the pullback in a bullish market condition to create the swing low. And then you can see price would now give the impulsive move after price creates the swing low. and then price will create another swing high. So whenever the impulsive leg move breaks through the swing high point, that is what we call the breaking structure. Because meaning this structure point has actually been broken. It has been violated to the upside by the impulsive move. So you would see price will create the pullback to the downside, create another impulsive move to the upside, and then price will break this swing high points. Price will give the corrective leg move, give the expansive leg move, price will break this swing high points. So in a bullish market condition, when the market is actually breaking swing high, that is what we refer to as a breaking market structure. When price breaks a swing high, it is still giving us the signal that the market is still continuing in the bullish trend. So this is what you must understand. So when we continue with understanding market condition, where we continue to mapping out institutional market structure and institutional order flow, you will be seeing this BOS. This signifies, or this actually means break of structure. It is break of structure. Why? Because price broke through the swing high points. So the market is creating series of higher highs and higher lows. So in a bullish market condition, you'll be looking at price to break the swing high points, and then that validates the continuation of the bullish market condition. So next we now have is actually to look at a chart example to make you understand how to actually map out a bullish market condition. Don't forget, this is just a basic understanding of identifying market structure. So you can see here, we have this low points here, and you must understand that this is the United States dollar paired with the Swiss franc. And then you would see that this is the low point, and then price created the impulsive leg move. Price created this swing high points that you can see here. So we have this low, and then we have price created the high. Now we have the pullback to the downside, and you can see now price created the impulsive leg move, and then you can see that we have price broke through the swing high points. So we have break of structure. This is telling us that the market is still in the bullish market condition. So we have the push of price to the upside, and then we have the pullback to the downside. Price created a new higher low points. Price gave the impulsive leg move to the upside, and then you can see we have the break of the swing high points. So we have the break of structure here. Now price gave us the pullback to the downside. So you can see the pullbacks are actually bearish movements, actually downward movements. So you can see here the ash candles are actually the bullish candles, while the black candles are actually the bearish candles. So you can see that I told you guys in a previous episode that when you hear the word bearish, it means a selling market condition. When you hear the word bullish, it means a buying market condition. So in the chart example we are seeing here, the black candle is actually the bearish candle, and then the ash colored candle is actually the bullish candle. So you can see now we have this series of bullish candles to the upside. And you must understand that within the expansive level move, you're going to be having bearish conditions. So when we continue further into the fractal nature of price delivery, then you get to understand that. So now we have the pullback to the downside, and then price created this expansive leg move. You can see you have more series of bullish colored candle than the bearish colored candle. And then here we have the pullback, where you can see you have more of the bearish candle than the bullish candles. So you can see now we have this expansive leg move because this created the higher low point, and then price gave the expansive leg move that took out this swing high points. And then you have this pullback. We have a new higher low because this is higher than this other low. And then price created another impulsive move to the upside, breaking this swing high points. So when we continue, also get to understand what validates a break of structure in the markets. So now this is the daily time frame. So the next market condition we have is actually the bearish market condition. So just the way I've told you guys, the bearish market condition is a selling market, a downtrend market. So the bearish market condition is actually a market condition that is creating series of lower highs and lower lows. So the bullish is creating series of higher highs and higher lows. The bearish market condition is creating series of lower highs and lower lows, because it is actually a downtrend market, a falling market, meaning it is actually showing us the falling price. So what you can see here, we have the impulsive leg move to the downside. So in the bearish market condition, the pullback is actually a bullish move. The impulsive move, the expansive move, is now the bearish movements in a bearish market condition. So you can see this is the expansive leg move to the downside. So this is now the pullback, or what we call the corrective move or retracements. So you can see the pullback is actually a bullish move to the upside. So you can see we have price created this low, price created this high. So from this high, we have the push of price to the downside. Price created a new low. But then this is actually a lower low, because it is actually lower than the previous low. And then we have the pullback to the upside, and then price created this high points. But then this is not a higher high. It is a lower high, because it is lower than the previous high points. And then price gave us the impulsive leg move again to the downside, and then created a new low point. And then this new low point is now a lower low, because it is lower than the previous lower low. And then we have the corrective move to the upside, the pullback, or what we call the retracement. And then price created the new high points. And then this new high point is actually a lower high, because it is lower than the previous high. And then we have the continuation to the downside. So the bearish market condition is a market condition that is actually creating a series of lower highs and lower lows. So when it comes to actually identifying the swing points, so in the bearish market condition, we have the swing low and we have the swing high points. So when price violates the swing low points, it is actually showing us the continuation of the bearish market condition. So what you can see is that we have this swing low points here. Price created the swing high points. So from the swing high points, we have the impulsive move to the downside, and then price takes out the swing low points. Because in the bearish market condition, the market is actually creating lower prices. So we're expecting to see price taking out swing low points. So we have the expansive move to the downside that took out this swing low points. Price created another swing low points. So what we can now see, we have the pullback to the upside. Price created the swing high points. And then from the swing high points, we are to expect the impulsive move to the downside to actually take out the previous swing low points. That is now actually showing us the break of the market structure, because the structure is to the downside. So we're expecting to be seeing swing lows being broken. So the pullback is actually going to pull back to fill up any form of inefficiencies in the impulsive leg move, to mitigate any form of sponsorship candles, which in coming episode, we're going to look at the sponsorship candles and also the institutional order flow. So this is actually the bearish market condition, creating series of lower highs and lower lows. So when we look at this chart example for the euro dollar, and this is also the daily time frame, what you can see here, we have a bearish market condition to the downside. You can see we have the high points here, and then price created the low points because price broke this particular swing low. So we have this low points. So now you can see price gave us the bullish move, which is actually the pullback, and then price created the swing high points. Now you can see we have the expansive move to the downside that broke this swing low points. And then we have the corrective leg move, the expansive leg move, and then we have the break of the swing low points. So you can see that the market is moving to the downside, where price is violating previous swing low points. Price broke the swing low points, price gave the pullback, created a new low points, gave the pullback, gave the expansive leg move, and then took out that swing low points, created a new low points. Price gave the pullback, pushed to the downside, broke that previous swing low points, creating a new swing low points. So this is actually the bearish market condition. So now we're going to actually look at also based on the weekly time frame, how this particular daily structure, you can also see it in the weekly time frame. What you can see is we have the expansive move to the downside. So you can see that in the bearish market condition, you're going to have more of bearish candles in the expansive leg move. We can see we have black colored candles, which I told you the black colored candle signifies a bearish movement. The ash colored candle signify the bullish movements. So you can see we have more of the black candles. So we have the expansive leg move. There within the corrective leg move, you can see we have bullish colored candles to the upside. Now you can see in the expansive leg move, we have bearish colored candles. In the pullback, we have bullish colored candles. The expansive leg move, we have more of bearish colored candles. You can see in the pullback, we have more of bullish candles. And then we also have this expansive leg move. So you can see how we have the expansive leg move. We have the pullback price created this lower high because this high is lower than the previous high. And then we can see price created a new lower low when the market actually pushed to the downside and took out this previous low. So this is a lower low because it is lower than the previous low points. So this is how you actually identify the bearish market condition and also the bullish market condition. So when we actually want to look out for reversal in a market condition, when there is actually a market structure shift, whereby you are actually having a bearish market condition, and then from the bearish market condition, you're going to see that you now have a bullish market condition coming up. What you're going to see is, since we have in this particular part of the diagram, we actually have price forming series of lower highs and lower lows. Because you can see we have the impulsive move, we have the pullback, price pushed to the downside, took out the swing low points. We have a break of structure. Pullback, price gave us the impulsive leg move, took out the swing low points. We have a break of structure, creating a lower low points. Price pullback gave us this swing high points. Now, this swing high point sponsored the movement of price to the downside, gave us the impulsive move to the downside that took out the swing low points. But then what you're going to see is when the pullback was coming, we have that the pullback pushed to the upside and then broke through the swing high points. You can see that in a bearish market condition, price is breaking swing low points. It is breaking the lower lows, not the lower highs. But then we're now having the market giving us a reversal signal. So you can now see from a bearish market condition, we switch into a bullish market condition. What actually validates the bullish market condition is that you would see that when the corrective move was coming to the upside, the corrective move broke through the previous swing high points that the bearish market condition created. So you can see price broke through this lower high points. So you can see we have push of price to the upside. Price closed above the lower high point. So we have a market structure shift. So from a bearish market condition, we've now switched and shift into a bullish market condition. So we have a market structure shift at this swing high points. Now price created a high because this is higher than this high points. This is a lower high. But now price created a high point. And then we have the pullback to the downside. Price created a low. This is not a lower low because it is not lower than the previous low. So it is now a low. And then you can now see that the low sponsored the impulsive move to the upside that took out this high points. So now we have a higher high because this is higher than the previous high. And then we have the pullback to the downside. Price created the swing low points. But then this is a higher low because it is higher than the previous low points. And then we have the impulsive move again to the upside. Price created a new high, which is a higher high because it is higher than the previous high. And then we have the pullback to the downside. Price created this swing low and then the impulsive move. So we have a higher low because it is higher than the previous low. So you can see in a bearish market condition, we're having price breaking low points. In a bullish market condition, we are having the price breaking swing high points. So This is how you identify when the market is actually switching from a certain market condition to the opposite market condition. So you can see here, this is a chart example. What you can see from this analogy is that we have a bearish market condition that switched into a bullish market condition. But then in the chart example, we're going to be looking at a bullish market condition that switched into a bearish market condition. So what you can see is that we have the impulsive leg move to the upside. You can see this series of impulsive bullish candles to the upside. So we have the impulsive leg move to the upside, price created this high point. We have the drop of price to the downside, price created the low points. Price pushed further to the upside, and then we have price created this swing high, which is higher than the previous swing high. So we have a higher high, a pullback to the downside, price created a swing low, which is actually higher than the previous low point. So we have a higher low point. So you can see that in this condition, the market is breaking structure to the upside. It's breaking what? High points. Now, what you're now going to see here, we have the drop of price to the downside, but then this movement did not push further to the downside to actually break the last swing point that was created in the bullish market condition. Because this is the low point that sponsored the bullish move to the upside that took out this high points. So for us to actually validate the reversal, so we must see that price takes out this low points. So price fell to the downside, pushed to the upside, but failed to continue the movement to the upside to actually break this swing high points. So what we have is that now price created a high point, and then price gave us an impulsive leg move to the downside that took out this swing low point that sponsored the move to the upside that took out the swing high point. So you can see now we have what? A market structure shift. This is the valid swing low, not this particular swing low, because this swing low did not sponsor for the bullish move, for the impulsive move to the upside to break through this high points. So you can now see price fell to the downside, and then we have a market structure shift. So we have high, and then we have the low points. Price gave the pullback. So we have price created this swing high point, but this is a lower high point because it is actually lower than the previous high points. And now price for the push to the downside and then broke the swing low, gave us the pullback, created another new lower high point, and then we have the impulsive leg move to the downside that broke this swing low points. So you can see in a bullish market condition, we're having the market breaking swing high points. In a bearish market condition, we're having the market breaking swing low points. So we have a market structure shift when the corrective leg move gives an impulsive move that breaks the last swing point that was created. So now you can see we have this movement to the downside that broke this last swing point that was created, that sponsored the movement to the upside that created the last high swing points. So this is how you actually identify the reversal in the markets. So the next type of market condition we are actually having is the ranging markets condition, whereby the market is not giving you a series of higher highs or higher lows, or giving you a series of lower highs and then lower lows. The market is just basically within a particular zone. So the market is actually moving within a support and a resistance. This is a support because when price returns to it, it bounces to the upside. This is resistance because when price returns to this, it pushes price to the downside. Price is facing resistance here. It's not being able to break through. While in support, price is finding a surface that enables it to push through the upside. So now you can see now we have price created this point, price pushed to the upside, drop back, we tested this particular support, push to the upside, price did not push further to break these high points. Then we have return, price did not fall to break this low point, price pushed to the upside. Price actually broke through this high point, but then you cannot say the condition is what? Bullish, because this is actually the high point that this low points created. So price return, price push to the upside, return, push to the upside. So you can see that the market is not really giving you structure. Price is just moving sideways. So you can see that this is the chart example, and this is the gold USD pair. So what you can see, we have this impulsive move to the upside. Price broke through this swing high points. Now you can see price return to the downside, created this swing low. But then price push without breaking this swing high. We have this swing low here, created this swing high. Price gave us the pullback, created a swing low. But then this swing low did not create a movement to the upside to actually break through this high points. And now we have price return to the downside. Price again did not push further to the downside to break this swing low points. And then we have price returning to the upside. So you can see how the market is just ranging within this support and this resistance. So this is what we actually identify as the ranging market condition. So you can see basically I've showed you guys 3 market conditions that are very important for you to know. And it is advisable for you to actually trade a trending market. That is the bullish market condition or the bearish market condition, where the market is actually giving you a series of higher highs and higher lows, or lower highs and lower lows. Then for you to actually trade a ranging market, you must actually have a level of proficiency for you to want to actually make an attempt to actually trade a ranging market. So this is all I want you guys to understand about market condition. So the next we're going to be looking at is actually the fractal nature of price delivery. Then in the next episode, we are going to deeply look at how to map out ideal institutional market structure. So understanding the fractal nature of price delivery. First thing I want you guys to understand is that price is fractal. And in every sense of the word, what I'm actually trying to make you understand is that there will always be a trend inside of a trend on every chart time frame. If you can remember, in the previous episode, I told us about the time frames we have in the trading platforms. So in every time frame, there is actually going to be structure. So if there is structure in a higher time frame, there is going to definitely be structure in a lower time frame. So let's say 4 hours is your higher time frame, and then your entry time frame is the 15 minutes. So you're going to find structure in the 4 hour, and within the 4 hour structure, you're going to find the 15-minute structure. So this is what we mean by the fractal nature of price. So price is fractal on every time frame, meaning what you see on higher time frames also happens on the lower time frames even more often. So the fractal nature of price occurs in higher time frame trends and also in lower time frame trends. This is why it is so important to know what the higher time frame trend is always before going to the lower time frame, to actually look out for your zones of entry executions and then your take profits levels. So guys, let's actually look at a bullish market condition to actually understand the fractal nature of price delivery. So you can see that this actually symbolizes the major market condition, and then this symbolizes the minor market condition. So basically what I'm trying to say is this signifies a higher time frame market condition. This signifies a lower time frame market condition. So the higher time frame could be daily, the lower time frame 4 hour. The higher time frame could be 4 hour, the lower time frame is 1 hour. So now you can see that in the higher time frame, we actually have a bullish market condition, because what you can see is that we have the market giving us a series of higher highs, higher low, higher high, higher lows. We have the impulsive leg move that broke this swing high points, created a new high point, which is now a higher high. Price gave the impulsive leg move, broke through the swing high point. We have a newly created high points. So now what you can see is that within the impulsive leg move, we are having the minor market structure. So also within the corrective leg move, we are also having a minor market structure. So now what you're going to see is we have an overall bullish directional bias. But in that bullish directional bias, we are also having bearish market bias. So the bearish market bias in our established directional bias in the higher time frame is actually the minor market condition. It is not actually saying that the overall bias of the market is now bearish. So you can now see that in the higher time frame here, we have a bullish market condition. So you can see in alignment to the impulsive leg move, which is in the direction of the trend, we have also the lower time frame structure giving us a bullish market condition, because you can see series of words: higher high, higher lows, higher high, higher lows, higher high, higher lows. But then now you can see that now we have price drop to the downside and then broke this higher low point that created this higher high. So some may mistakenly take this as a reversal in the markets when you actually just base your observation on the lower time frame and neglect the higher time frame, which is actually giving you the major market condition. But when you actually establish from the higher time frame the major market condition, then you would realize that this bearish market condition is just a pullback leg move in the higher time frame. It is not actually a reversal market condition. So now you can see now in the impulsive leg move, we have this, you definitely know that the impulsive leg move is actually a bullish move. So in the impulsive leg move, we have a lower time frame market structure, which is also what? Bullish. Now in the corrective leg move, which is actually a bearish market condition. So you would see that in the lower time frame, you're going to be seeing a bearish market condition. We're going to be seeing the market is giving a series of lower highs, lower lows, lower highs, lower lows. That doesn't mean that the market condition, the overall market condition, is now bearish. No, it is just a pullback leg move to the downside for price to come, retest a zone within the impulsive leg move, and then we have the continuation to the upside. So this is why I said we must understand that the market is actually fragile in nature. You would find structure in higher time frame, and then in lower time frame you're going to find structure. So let's take the major market condition as a market condition in a daily time frame, and then this minor market condition is actually a market condition in a 4-hour time frame. So you can see now the 4-hour time frame in this corrective leg move is actually establishing a bearish market structure. But this is just a corrective leg move. It is not a directional bias to the downside. But though in the lower time frame, it sees a bearish directional bias. So next, what you must understand is, the market does not just move in a straight line. The market does not just move just where we see here. The market gave this impulsive move. You just have a straight movement to the upside, straight movement to the downside, straight movement to the upside. No. You would see that the market is giving you this particular kind of waves when the market is moving. So you must understand that this is actually now the bullish market condition. But then you would see that you're going to be having structure within that particular established bullish directional bias. So which is actually going to be a market condition in a lower time frame. So you can see we are in a bullish market condition, but here you can see we have a bearish movement to the downside. That doesn't mean that the market is actually bearish because you see the violation of the swing low points. No. So the market is actually fragile in nature. So you can see that the structure in the higher time frame is bullish because we have series of higher highs, higher low, higher high, higher lows. But then you must understand that the market moves like a wave. It is not just a straight movement to the upside. This is actually the USD to the Swiss franc. So now what you're going to see is that this is the 4-hour time frame. You can see that in the 4-hour time frame, this is the structure within the 4-hour time frame. I've shown us this chart example. But in the daily time frame, this is the structure. We have the low, the high, the higher low, the higher high, the higher low, the higher high, the higher low, the higher high, the higher low. So this is the daily structure. We're having a bullish market condition. But what you can see in the 4-hour time frame, you can see that we have in this impulsive leg move of the daily directional bias, you have in the 4-hour time frame, we are having this bullish market condition. We have price created this high, price pullback, push to the upside, created this high, pullback, push to the upside, created this high, pullback, push to the upside, created this high, pullback, and then price broke this low point. So that doesn't mean that the market is bearish. So this is just bearish move in the lower time frame, which is actually the 4-hour time frame. But in the daily time frame, it is just the corrective move. Because in a bullish market condition, the corrective leg move is actually a bearish move to the downside. And then the impulsive leg move is now a bullish market condition. So you can now see we have the push of price to the upside. Price went to the upside, broke this high point. Price realigned itself to the main directional bias. So this is actually for a bullish market condition. So now you can see that this is the daily time frame. Now what you can see in the daily time frame is this is the impulsive leg move, this is the pullback. But then when you drop to the 4-hour time frame, this yellow line is actually the structure within the 4-hour time frame. Where you can see it is not easily identified in the daily time frame as structure. When you drop to the lower time frame, you can mark out the structure. So you can see we have what? Structure within structure. So we have the daily time frame as a bullish market condition. And then you can see we are having the 4-hour time frame within the daily structure. So this is how you actually identify the major market condition from the minor market condition. So now let's check out the bearish condition. So in the bearish condition here, you can see that the overall directional bias is actually bearish because we have the market creating lower highs, lower lows, lower highs, lower lows, breaking structure to the downside. So you can see in the impulsive leg move, we have a bearish market condition in the minor market condition. So you see, we have the major market condition, which is bearish. In the impulsive leg move, we have the minor structure, which is also bearish. The pullbacks gives us what? Bullish market condition. Because you can see prices creating what? Higher highs and higher lows in the pullback leg. Now price returned to the downside, gave us this high point. Price dropped to the downside, broke this previous low point. So you can see now price realign itself to the major directional bias. So you can see that words, the market is actually fractal in nature. You see structure in higher time frame. You also identify structure in the lower time frame. So now what you can see is just the way I've explained with the bullish market condition. The market does not just move straight to the downside, pull back straight, drop to the downside, pull back, and then no, it moves in a wave form. So now you can see that we have price push to the downside, pull back, push to the downside, price push, pull back, push, created a high point. This is the low point. We have this movement to the downside that broke this swing low point. So we have a breaking structure. So you can see we are having a bullish market condition in the pullback leg move. And then we have now a bearish market condition in the impulsive leg move. We're having a bullish market condition in the pullback leg move. And then we resume the bearish market condition in the impulsive leg move. So this is how the market moves. It doesn't just move in a straight form to the downside, straight form to the upside. So now let's look at chart example to that. So this is the Euro USD. This is the 4-hour time frame. So this is actually the daily market structure, the thick black line you're actually seeing. So we have price creating lower highs, lower low, lower highs, lower low, lower highs. So we have a downtrend market. So if you can observe, now you can see in the 4-hour time frame, we have structure within structure. So we have the 4-hour structure within the daily market structure. So now we have price pull to the downside here, price push to the upside. We have push to the downside, price broke this low point, give us a pullback, push to the downside, broke this low point, pullback, push to the downside, broke this low point. So you can see we have the bearish move in the 4-hour time frame aligning itself to the daily impulsive leg move. And then now we have the corrective leg move giving us bullish market condition. Now we have the impulsive leg move to the downside, price push to the downside, took out the swing low, price pullback, push to the downside, pullback, push to the downside. Now we have the corrective leg move giving us a bullish market condition. So now you can see the fractal nature of the price in the market. Now you can see this is now the daily time frame so that you can see the picture clearly. You can see in the daily time frame we have the high points, price push to the downside, took out the low points, price created this low, push to the upside, gave us the lower high, price push to the downside, took out the swing low point. So you can see this is the entire impulsive leg move. But what you can see in the 4-hour time frame is you can see that we have structure in the 4-hour time frame also. And so this is the entire impulsive leg move. And then you can see we are having what? Bearish structure from the 4-hour time frame. Now this is the entire corrective leg move. And what can you see? We are having what? Identified bullish market structure from the 4-hour time frame. So this is how you must look at the charts. You must establish your structure from a higher time frame so that when you drop to a lower time frame, you don't get confused by the structure in the lower time frame. So meaning you trade in confluence with a higher time frame structure. So now in a lower time frame, when you see the break of this high, you can see this is a reversal. But no, in the higher time frame, where you can see we're still in a bearish market condition. This is just a corrective leg move, a pullback, a retracement to the upside. So now you can see that also when we are actually in a market condition that leads to a reversal, you can see the major market trend here is actually bearish. The major market trend here is bullish. So you can see this blue line is actually the minor market condition. So you can see that now we have price took out the swing low points. Price pushed to the downside, gave us the impulsive leg move, pullback, created this high point, pushed to the downside, took out the swing low points. Now, what you're going to see here is price in the impulsive leg move in this bearish condition is giving us bearish structure in the minor markets condition in the lower time frame. Now, when you see that price pushed to the upside and then price took out this high points, this doesn't mean that the bias of the market is now bullish, but rather this is just a bullish move in a lower time frame, signaling just a corrective leg move in the higher time frame. And then you can see price return to the downside. We have the pullback, price to cut this high. This is not saying that the market now has turned into a bullish directional bias. No, this is just a lower time frame change in the market condition, but the higher time frame is still bearish. And then price fell to the downside, created this lower low points. Now you can see this lower low point sponsored the move to the upside that broke this lower high points. This is when we now have the major market structure shift. This is just a minor market structure shift based on the minor market condition. When price took out this high point, this is just a minor market structure shift. That doesn't mean that the market has turned into a bullish market condition as the overall directional bias. Until when price breaks through this high point, then we have a full market structure shift. Meaning now the market is no longer bearish. The market have turned into a bullish market condition. And you can see we have the pullback and then price continued to the upside. So you can see how price is fractal on every time frame. Meaning what you see on higher time frame also happens on the lower time frame, even more often. Because now you can see we have in the higher time frame, we have a bearish market condition. But then in the lower time frame, you can see we have bearish, bullish, bearish, bullish, bearish, bullish, bearish. So the markets or price delivery is actually fractal. There is structure in higher time frame, there is structure in lower time frame, and the structure in lower time frame occurs more often. That is why you must establish the structure, the trend in the higher time frame always before going down to the lower time frames. So this is what you must understand about the fractal nature of price. So now let's look at this example. This is actually the 1 hour time frame. So meaning we're going to identify the 1 hour structure. So we establish the structure from the 4 hour time frame. So the 4 hour time frame is the higher time frame. The 1 hour time frame is the lower time frame. So you can see the structure from the 4 hour time frame. We have the impulsive leg move, the corrective leg move, impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive. Now price pushed to the upside, took out this high point. So we have a market structure shift. But now what you can see in the lower time frame, in the 1 hour time frame, we have this impulsive leg move. We have a pullback, impulsive pullback, impulsive price pushed to the upside, took out this high. that doesn't mean that the overall direction of the market is now bullish. No, it is bullish in the lower time frame. So it is a minor structure. Now price continued with the trend to the downside. Price gave us the pullback, which is actually a bullish condition. Price resolved to the downside. Now this is when we have the shift in market structure, when price pushed to the upside and took out this high points. Now you can see this impulsive move took out this high point. This is a minor market structure shift until price takes out this high points before we actually have a major market structure shift. And then price took it out and also took out this. And then you can see we have pullback to the downside, push to the upside. So from a bearish market condition to a bullish market condition. So let's check the 4-hour time frame. So you can see it here in the 4-hour time frame. You can see in the 4-hour time frame we have the impulsive leg move. This is the ideal pullback in the 4-hour time frame. But then you can see in the 1-hour time frame we're having a pullback here, and then price fell, took out this low, pullback, and then pushed to the downside, took out this low. But what you can see in the 4-hour time frame, we're just having this as the impulsive leg move, and then this as the ideal pullback. And then we have the impulsive leg move, this as the ideal pullback. Impulsive leg move, this as the ideal pullback. But when you check the lower time frame, you're going to see that we have structural move to the downside, took out this, pullback, move to the downside, took out this, push to the upside, and then we're having this bullish condition. But when you check in the higher time frame, this is the entire corrective leg move. And then price push to the downside, give us the corrective leg move, price push. Then now we have the movement to the upside that took out this high, leading to the what? Market structure shift. This is the ideal pullback. Where you can see in the lower time frame, you would see that you have this as a pullback here. Price took out this. That is just a minor market structure shift. But this is the major swing high point. Until price violates this, we do not have a reversal condition. So this is how you must actually look at the chart. You must establish the major market condition and then the minor market condition, so that you would know when to actually expect an ideal reversal in the market and when to also keep yourself in the market in the direction that the market is actually trending. So this is what you must understand. You should actually go back to the chart, back test these things, map out these conditions in your chart so you understand how to actually map out these things as easy as possible. So next, let's actually look at the ranging market condition. So what you can see in the ranging market condition is this is actually the major market condition in the ranging markets. So you can see that in this particular movement to the upside, in a lower time frame, you're going to actually be seeing structure. So you can see even in the ranging market, you can actually utilize the movement and actually have trade executions in a ranging market. But then this actually requires level of mastery. Because you can see in this downward movement of price to the downside, you're going to see in the lower time frame, you're going to be having a bearish market structure, giving you what? The minor market condition. So basically what I'm trying to make you understand is you can see we have push to the upside. You can have this to the downside, price push to the upside. You can see price will just give you this movement again to the downside. Just the way I told you, the market does not just move in a straight line and then falls, push, fall, push, and then what? Fall. So let's look at chart example to actually identify that. So you can see this is actually the 4-hour time frame. We actually identify the major structure in the daily time frame. So this is actually the major structure. We have price push to the upside, push to the downside, push to the upside, push to the downside, push to the upside. What you can see in the 4-hour time frame, you have this impulse, you have pullback, you have impulse, and then you have pullback. Price push to the upside, failing to break this, price return to the downside. So you can see you have a bullish condition here, and then price gave a bearish condition here. Price gave a bullish condition here because it took out this high point. Price gave this pullback, return to the upside, pullback, broke this swing low point, giving you now a bearish condition here. So now what you're going to see in the daily time frame is you cannot actually vividly identify the structure of the 4-hour just by looking in the daily time frame. So, but the fact that we've marked it out from the 4-hour time frame, now you can identify it here as price give this movement, return give this movement, fell to the downside. But then you can see in the daily time frame, you just have the impulsive move, price fell. Impulsive move, because you can see a series of what? Bullish candles, price fell. You can see you have more series of what? Bearish candles. So this is the market condition and how to identify their fractal nature. So till I see you guys next time, cheers and God bless you.